Nearly all Federal Reserve policymakers agreed earlier this month to slow the pace of their rate increases to a quarter point. Only a few supported a larger half-point hike. The minutes from the Fed's January 31st to February 1st meeting said most officials supported the quarter-point increase. This is because a slower pace would better allow them to assess the economy's progress toward reducing inflation to their 2% target. The increase raised the Fed's benchmark rate to its highest level in 15 years. It followed a half-point rate increase in December and four three-quarter-point hikes before that. Well, joining us now to tell us more about the federal funds target rate is Brendan Caldwell, director at Caldwell Securities Ltd. Brendan, welcome back to Forum Daily.
Thank you, Nima. This is going to be a tough one to make it sound interesting, but we're going to make it happen.
Well, to really simplify things for our viewers, Brendan, what exactly is the Fed funds rate and why is it important for investors?
Well, it's the rate at which the lender of last resort, the U.S. Federal Reserve, will lend to the commercial banks like Bank of America or Citibank or these big U.S. banks. It's the rate at which they will lend to the big commercial banks in the U.S. The equivalent up here is the Bank of Canada rate, which is the rate at which the Bank of Canada will lend to the Royal Bank or the TD. So the central bank of a country is thought of as the lender of last resort. If you need to borrow money as a commercial bank for liquidity reasons, you borrow from the central bank, and the rate at which you're borrowing from the central bank defines then the rate above which you're going to mark up for the money that you're going to lend out to mortgages or home equity lines of credit or commercial lines or everything else. Everything else is going to be based off that rate. So the bank's prime rate will then be some level above the Bank of Canada rate, or in the case of the U.S. Fed funds rate, and the savings rates will still be well below them. So it's the defining rate off which the big commercial banks in Canada and the U.S. Figure out what they're going to lend to their customers and how much they're going to pay their customers to have their money on deposit.
And really bringing this back home to Canada, how does the federal funds target rate impact Canadians in particular?
How it actually affects is more of the price of the dollar. See, whoever is ahead or behind, there have been times when the Bank of Canada has had a pretty aggressive monetary policy. And you hear people dressed like me talking like this and using words aggressive monetary policy. It means that they are the Bank of Canada or the U.S. Federal Reserve is either raising interest rates or making money less available, the constricting credit, so pulling money back in from the system. And there's been times when the Bank of Canada has been more aggressive. And those have been the times when our dollar has got up to 90 cents or par, 100 cents on the US dollar, which is not ideal. If you want to slow the Canadian economy down, just get our dollar up around 90 or 100 cents on the US dollar, and very little happens. It makes exports far more expensive. It makes manufacturing here. It makes the production of movies in downtown Vancouver and downtown Toronto too expensive. And given that my son is now an aspiring actor, I can't have that happen. So about the 75, 80 cents seems to be about the sweet spot. We're on the sort of low end of that range right now. So when the U.S. raises interest rates, that makes the U.S. dollar more attractive because it makes U.S. bonds and interest rate bearing products more attractive. So when the U.S. Fed funds rate goes up, it tends to make the U.S. dollar go up, and relatively speaking, the Canadian dollar go down. And the reverse is true when the Fed lowers rates or when the Bank of Canada raises rates. Simple, eh?
Lots to see how intertwined the Canadian and U.S. economy is. Now, another thing I want to jump to, we just have about a minute left here, Brendan, is thoughts or concerns around a recession. So a lot of people are pointing to an inverted yield curve that began flashing red last year. So what exactly does this inverted yield curve mean? And is it a reliable predictor of a recession?
Yes, I think it's successfully predicted 50 of the last 7 recessions. It is a way of suggesting that the economy might slow down. In fact, it's intended by the central banks to slow the economy down, and as you alluded to in your introduction, to keep inflation down. But as you said in your introduction, all they're debating at the central banks right now is by how much to raise rates. Rates are still going higher. My advice to People say with floating rate mortgages, well, first off, pay them off if you can. If not, I would suggest locking in that rate, whatever it is right now, because I do think between here and some point in the future, rates are going to keep going up. I would say even for the rest of this year and maybe into 2024, which is not the prevailing wisdom out there. So for most of your listeners that have rates that are potentially going higher, I would see about locking them in now.